Good day, ladies and gentlemen, and welcome to the SOFTRAX Executive Webcast. My name is John, and I will be your coordinator for today. At this time, all participants are in listen-only mode. If at any time during the call you require assistance, please press star followed by 0, and a coordinator will be happy to assist you. As a reminder, this call is being recorded for replay purposes. I would now like to turn the presentation over to your host for today's call, Mr. Bob O'Connor, President and CEO of SOFTRAX Corporation. Please proceed, sir.
Thank you very much, John, and welcome to everyone to today's webcast. SOFTRAX is the leading provider of revenue management solutions to hundreds of companies. Many of our customers join us on the call today, so welcome to you and welcome to everyone. We have approximately 2,000 people registered for today's webcast, which indicates how much executives want to hear about today's topic from our distinguished speaker, Dr. Tony Sondhi, who's back from popular demand, joining us from London to make his presentation entitled EITF 0801. Revenue recognition and you. Tony finds himself in the eye of the storm on this issue as it continues to unfold, and so this webcast is very timely. Let me just take a few minutes, and I'll take you through some housekeeping issues. I will spend a few minutes on SOFTRAX and our role in this topic, and then I'll turn the webcast over to Tony, who will make his presentation as you see on your screen. For those of you who are unfamiliar with our webcast format, we do leave time at the conclusion of Tony's prepared remarks to answer your questions, and we'll conclude this webcast by the top of the hour. Now, to ask a question, I will be reading your questions throughout Tony's presentations, and I'll monitor them throughout and ask him as many as time permits. But if you want to ask a question at any time, please look at your console, and you'll see an Ask a Question feature located in the lower left-hand corner. Click on that, and again, I'll be reading those throughout the presentation. And the most commonly asked question is, can I get a copy of the slides? And the answer is yes, but we do make you work a little for that. We ask for about a minute of your time, and today it'll be a very valuable minute. And so at the end of the webcast, you'll see an online survey that will be available to you. Tony, we listen to these. Tony's presentation today is a result of your previous surveys. So that'll allow you to get the slides. It'll also give you a link to, if you want to get a rebroadcast of that. You'll also need to submit the survey to get CPE credit. Everybody is entitled to 1 CPE credit, but again, you have to submit the survey to do that. And then 10 lucky winners will randomly get a free copy of the 2009 Revenue Recognition Guide, of which Tony is an author, and so we'll let you know by email. Lastly, I just want to let you know and have you think about, and it's not listed on your slides, but we are working on a survey with FASB staff. The survey relates to the ISB and the FASB revenue recognition discussion paper, which was a topic of a recent webcast that we did. We have a lot of response that we're doing on the survey. We'd like you to be able to also respond if you haven't. And that at the end of the webcast, we'll give you instructions on that. The deadline for that is tomorrow, so if you'd like to be heard, we'd like you to be heard, and we'll give you a facility to do so. So that concludes some of our housekeeping issues. So a little bit on SOFTRAX, and then we'll turn it over to Tony. SOFTRAX develops enterprise software that manages all aspects of a company's revenue cycle. Throughout the U.S. and throughout the world, several hundred companies from many different industries use our software to manage their complex billing, revenue recognition, revenue allocation, reporting, and forecasting. And as you may know, SOFTRAX started out by serving the complex revenue needs of software companies, and we're the clear leader in that market. And as you can see, we have grown to address the complex revenue needs in many industries today, and that list keeps expanding. Our software suite is designed around the operational strategic needs of the CFO and the financial staffs of companies who are frequently challenged by the multitude of business models, compliance issues, and reporting issues that they need to deal with. Our applications consist of billing and operational applications that handle things such as contract management, complex billing, contract renewals, and order management, unparalleled revenue recognition capability in terms of revenue accounting and revenue expense accounting, and analytical applications that are needed to improve visibility and make strategic decisions. And all this functionality can be licensed individually or together as provided in 2 offerings. Our offerings are billing and revenue management solutions, where we use our deep domain expertise for many years of doing this, and expertise in many industries you see on the screen, from software to SaaS to business services and internet and information providers and more. And the second offering for those larger enterprises who have already or are considering implementing an ERP system, our Revenue Manager product is the most robust application and is very complementary to ERP applications. So our mission is to help our customers enhance their revenue top line while reducing their costs, taking out inefficient processes, and all the while allowing them to comply with the ever-changing regulatory environment in which we all live. So we're going to talk about revenue recognition today and 0801, with Tony leading the way on that. And we certainly view revenue recognition and the order-to-revenue process where people still rely on spreadsheets as a significant problem in the marketplace. The impact of managing revenue outside of enterprise system and with spreadsheets or custom systems is significant because of the materiality of revenue and related to getting that number wrong. There is a restatement risk, a high compliance risk. Studies find that based on the complexity and the volume of data, many companies cannot finalize their revenue numbers within a reasonable period of time, and they're also relying on broad assumptions with regard to revenue forecasting. And the reasons for such widespread manual processes and use of spreadsheets are reflected in many other studies, and these studies are provided in detail at revenuerecognition.com, and they're just at a very high level here. But clearly, the revenue figures and processes around those are the most difficult to manage due to the different business models, the different transaction types, and the volume. Certainly, the revenue is repeatedly coming up in these studies as the most difficult area in which to establish internal controls. And ERP systems and generic financial applications are not designed really to manage complex revenue transactions. And the enterprise process challenge that really is fundamentally at the base of the issue here is that for many industries, and as I said earlier, that list is growing, they really just cannot automate the classic order-to-cash process as their ERP and generic financial systems are designed to manage. As early on as the contract and the order, there needs to be a parallel automation, parallel processes, and integration to manage revenue. There really is a separate revenue track that starts as early as the contract and needs to be managed on a parallel basis with the classic order-to-cash process. And again, the enterprise process has an ongoing challenge, is that things are constantly changing, as you can see up here in the alphabet soup. And today, Tony will spend time on 0801. And we will continue to educate you as things become available to us, as we're doing today. And more importantly, we'll continue to provide solutions that reflect these changes. And so it's clear to all of us that systems are needed, and the best way to be prepared for all of this is to make sure that you are organized around an automated system, enterprise systems, and to make sure that the management and documentation of the revenue processes are in place. And of course, it's also helpful to know what's happening in terms of the ongoing regulatory issues, and that's what Tony is here to talk to us today about. And I'll turn this over to him. Tony is currently a member of the Emerging Issues Task Force, EITF, of the Financial Accounting Standards Board, which of course is FASB, its Agenda Committee, and its 2008 Working Group on EITF 0801. So we have the right person here at the right time to address this unfolding story. Tony's also a member of the expert panel, advisory panel on fair value for the IASB. He's the co-author of the Revenue Recognition Guide, the editions from 2006 to 2009, as well as the analysis of use of financial statements. And I could go on and on about his resume, but I think most people know Tony Sondhi. He's the right person for this topic, and we welcome you back, Tony, and the show is yours, sir.
Thank you, sir. Thank you, Bob. Okay. Well, welcome, everyone. EITF 0801, which bids to effectively change EITF 0021. And I'm going to try and do justice to it. I don't think there's enough time. But I'm really glad to see that there are many people who are on this call and this webcast. I think it's very important because as I speak to different audiences about this, I'm finding out that people have not actually spent a great deal of time thinking about this yet. And this accounting standard is actually going to have a rather significant impact, and therefore I think it's important that we take a look at it. So let's get started. I want to begin by talking about how we got into this issue altogether. As you know, the EITF gets inquiries, technical inquiries, and among those inquiries we started taking a look at one aspect of this issue, and that is more and more arrangements and transactions these days have multiple payment streams for a single deliverable, or sometimes, or very often, of course, it's also a single unit of accounting. That means we have more than one deliverable, but they cannot be separated under existing accounting standards. And probably three really good examples of that would be the first one, where you have service transactions with upfront payments that are followed by additional payments as services are provided. Now, the classic example of this is a healthcare provider, or I'm sorry, not a healthcare provider so much as a fitness, one of those companies, one of those places that you go to exercise. You normally end up paying these days an initiation fee to be followed by a monthly fee as you use the facilities. Similarly, you can think about places like Costco's, BJ's, wholesale clubs, and so on. And the question there is you've got one initial initiation or membership fee, and then you've got payments over time as the services are provided in the case of the fitness place, or, for example, in the case of Costco, where you go in and use the services in the sense of purchasing the different products that Costco has for sale. And the question there, which I'll take you through in just a second. Another possibility, of course, is where you have two or more subscriptions. But for various reasons, you cannot separate them, and therefore you end up with a single deliverable. And then, of course, we've got the most complex of these transactions, which are the biotech and pharmaceutical R&D arrangements. And these, many of these arrangements have several of the following deliverables that I'm going to tell you about. Generally speaking, a biotech has made a discovery. It does not, however, has all the resources that are necessary to convert that into a drug that they can then sell once they get approval from the FDA, and so on. So the biotech enters into an arrangement with a large pharmaceutical company. They give that pharmaceutical company an exclusive license to that particular discovery. Then they work with the pharmaceutical company's R&D team. So the biotech provides R&D scientists, the pharmaceutical company provides them, they all work together, the biotech gets paid for the R&D team that it provides, and that payment very often, or most of the time, is non-refundable. After that, the biotech gets paid if they get FDA approval in the U.S. They get paid another amount for FDA approval in Europe, or the equivalent thereof, and then approval in Japan, and so on. Once they start get this approval, they start manufacturing the drug. The biotech is the one that often manufactures the drug. It gets cost plus 30%. After that, the drug is sold, and as the drug is sold, the biotech receives royalties. So you've got all these different deliverables, various payments coming along, but since this is a one-of-a-kind arrangement, very often you can't separate anything, or not much anyway. Now, those of you who worked on and have been following EITF 0021 know that this is one of the examples in the back of that in Appendix B. So these were some of the issues that we were looking at. Let's look at what we find. Now, the questions that we started with. Our first question is that if you have a single deliverable but multiple payment streams, do you use a single revenue recognition method, or is it possible to use more than one? And what is the literature that supports using more than one revenue recognition method? The second case is where you have multiple payment streams which cannot be separated, and therefore you have a single unit of accounting. And in that single unit of accounting, you have multiple payment streams, and the question is, once again, whether you have to use a single revenue recognition method, or do you use permitted to use multiple. And please keep in mind that although I've stated in both cases what happens, what's permitted, and so on, don't forget that the objective in all of this is to do one's best to reflect the economics of the transaction. Okay, that's the rationale. That's what accounting attempts to do, to try to do its best to allow you to reflect the economics of the transaction. Now, so as I said, what are the different possibilities? Let's begin with our analysis of the single deliverable. Now, there are two views, and the first view effectively is that you only have a single attribution method because you've got a single deliverable regardless of the fact that you've got two or more payment streams. Effectively, you should only use a single attribution method. Now, that basically comes from a discussion in SAB Topic 13A. Now, SAB Topic 13 is on revenue recognition. It contains the Staff Accounting Bulletin number 104 and so on. And it is there that the SEC staff made the argument that even though you have multiple payment streams, the reason someone joins a health club is effectively to use its services. In other words, there's nothing separate that's being delivered to the customer as a result of the customer's payment of the initiation fee. Right? So all they've done is split up the payments into two pieces, one of which is an ongoing payment. However, all we're doing is providing access to the health club, and therefore there's a single deliverable. And consequently, there should be a single revenue recognition method. Now, is there another view? Sure. There's an alternate where, once again, and you will find that from the SAB topic, which basically says that although you have a single deliverable, the fact that you have multiple payment streams means that the payment for the use of the health club ought to be recognized as time passes. Whereas the initiation fee actually is a payment for the expected economic life of the relationship with of the customer with the health club, and therefore that gets recognized over a different period of time. So in that sense, even though a single deliverable exists, right, there's a single earnings process, that earnings process is completed over two different periods, and consequently you get to the multiple attribution methods. Now, let's take a look at a couple of other issues in here. Now, with the multiple attribution method, sort of a related issue is that of a milestone-based method. Now, in a milestone-based method, the argument that's made is that the upfront fees relate to the entire performance period. In other words, the economic relationship between the customer and the service provider. But the milestone payments effectively relate to the performance period that is dedicated to achieving a particular milestone. Now, please keep in mind that before the EITF started work on 0809 and before 0809 was issued, the milestone method in effect was not an acceptable accounting standard method because it's never been in GAAP. So until 0809, it was not in GAAP. Now, by the way, those of you who've used my book, The Revenue Recognition Guide, are aware that the milestone method has been in the Revenue Recognition Guide, and in fact, it was also discussed in it before I started writing it. To date, however, there's no word from the FASB or the EITF that they're going to pay us royalties for having come up with the milestone method before they did. But that's something that happens often over there. Anyway, so let's take a look at the issue of multiple deliverables. Remember I said that one issue you're looking at is the single deliverable where you have multiple payment streams. Now we come to multiple deliverables with multiple payment streams, but these multiple deliverables cannot be separated because of the requirements of EITF 0021. Now, once again, here the rationale is, the argument has always been that if you cannot separate them and end up with a single unit of accounting, then you also ought to come up with the most appropriate revenue recognition method. Now, we could, of course, take a look at the alternative view where there are people who read paragraph 10 in EITF 0021, which talks about the different possibilities and therefore suggests that you can use more than one attribution method. Now, one other thing that I wanted to point out was that the Technical Practice Aid 5176, which discusses contingent usage-based fees in 3 different types of multiple element arrangements, is another place where the implementation guidance in this case tells us that we can use 2 different attribution methods. Now, the 5176 actually reminds me of something else. As I've told you before, those of you who are working on revenue recognition, those of you who are working on other accounting issues, you ought to take a look at the FASB codification project. A very important piece that I want to mention about the codification project is all technical practice aids that relate to SOP 97-2 have been included in the codification. So this, as of July of this year, technical practice aids will also be authoritative revenue recognition guidance. Just a quick aside. Okay, now let's take a look at what happened then with respect to all of these issues that we were given, that we looked at. We had a meeting in March of 2008, and at that task force meeting, the FASB staff was asked to perform additional research, and at that point, a working group was formed. Now, you may recall, I've told you this before, working groups are formed in order to help the FASB staff obtain additional information. The working group normally is comprised of people from accounting firms and from companies in order to get help from people who have actually been working on these issues. And every so often we also have a user in order to assist with disclosures. Okay, now at that March 2008 meeting, the FASB staff was asked to do some further work on practice concerns, review the questions that should be asked to address those concerns, and then recommend a course of action for the task force. The working group discussed a few different things. Among them, the working group discussed the issue of straight line revenue recognition, which we decided was normally something that people do for convenience. We discussed the issues of milestone payments, contingently deliverable products and services, timing of cash receipts and revenue recognition, impact of that timing. Now, these issues were actually then the working group decided that they did not merit further consideration. What was important was the basic issue that I'm going to now show you. And the working group recommendations were then discussed at the September 2008 meeting. And there one of the most important questions was, should we change the fair value threshold? In other words, remember that in 97-2, the fair value threshold is VSOE, or vendor-specific objective evidence of the fair value. In EITF 0021, the threshold was objective and reliable evidence of fair value, or failing that, the third-party evidence of fair value. So the issue was, because the EITF 0021 requirement to have objective and reliable evidence of fair value or third-party evidence, there were many occasions where companies could not separate. And that barrier, one way to remove that was to come up with a different fair value threshold, possibly. As you'll see in a moment, what we decided to do at the EITF was something different. Of course, the interesting question at that point also was, what should we? What kinds of arrangements should be affected? So initial thought has been, and we've carried that through, is that EITF 0801 should be limited to arrangements that are subject to EITF 0021. Now, the second issue that we talked about was that if we're not going to use VSOE or objective reliable evidence of fair value, what should we do? And one thing that was recommended was the estimated selling price. Now, the estimated selling price, those of you who've looked at the revenue recognition discussion paper from the FASB and the ISB are aware where that comes from. Now, please keep in mind, though, that when we first started talking about this in September 2008, the objective, or at least the principle, was to think about estimated selling prices as applied to undelivered elements only, and then we would use the residual method. Of course, the idea at that point, or the objective, was to keep the estimate of selling price, that process itself, consistent with the objective of determining VSOE or objective and reliable evidence of fair value. Now, I want to show you what happened to this over time. But before we go any further, I'd like to take you back for a moment to EITF 0021 and show you how 0021 and 081 relate. Now, please keep in mind that we're focusing on paragraph 9 of EITF 0021. There, the task force had said that a deliverable should be segmented and accounted for separately only if it satisfied three different criteria. The first one, the delivered item has value to the customer on a standalone basis. Now, please notice that, and be very careful with this, this criterion applies only to delivered items. The next two criteria apply to the undelivered items, or undelivered elements, if you like. And that second criterion is the one that called for objective and reliable evidence of the fair value of the undelivered items or third-party evidence. Now, please keep in mind, we came to this because this was considered as the most important factor that prevents companies from separating deliverables. So in EITF 0801, the second criterion goes away. We're no longer using it. Now, the third criterion was when the arrangement includes a general right of return relative to the delivered items, then delivery or performance with respect to the undelivered elements must be deemed probable and substantially in control of the vendor. Now, so please keep in mind, in 081 we only have criterion 9A and 9C, whereas in 0021 we had all three of them. Now, so in September 2008, what did we do? As I said, remember we were talking about whether there ought to be a fair value threshold lower than VSOE or objective and reliable evidence of fair value. Well, it turns out that we did consider, we thought about some others, and then, as I said, now the idea is that we're going to be using estimated selling prices. In other words, we moved away from an exit price notion, which is in the 157 model. By the way, I find this rather interesting and very, very critical because we're talking about balance sheets being based on an exit price. I know that the FASB has made several changes to this exit price model, and 157 certainly is under attack through some of the amendments of 157, the amendments to EITF 99-20, and so on. But at the same time, keep in mind what we're doing here is the balance sheet stays with the exit price to a large extent, whereas the income statement is going to be based on something completely different, and that's the estimated selling price. Now, another question is, what are we going to do? How do we allocate discounts in this case? And then if companies are going to use the estimated selling price, what is the proper disclosure requirement? What kind of information do we ask for? Okay. So that was the September meeting. We come then to the November 2008 task force meeting. And there we started thinking in earnest and discussing the issue of how does one apply the estimated selling price. to the undelivered elements. And there were lots of questions that were raised about the residual method. Now we're at the point where we're saying that instead of the residual method, effectively what we're going to do is drop that and use a relative allocation based on the relative selling price. Remember, this is the estimated selling price. Okay. Some comments based on the November discussion. Now, these are issues that I'd like you to think about. I'm going to elaborate on the issues as I talk about them. Now, I recommend very, very strongly that those of you, and of course that means everybody who has to apply EITF 0021, take a very careful look at 081. There's a lot of work to be done to get ready for applying this, in order to apply EITF 081 whenever it goes into effect. Now, I'll talk about that in a moment as well. So some initial questions and comments. One possibility that comes to mind is that if we drop criterion 9b as we've done, does that raise the emphasis on criterion 9a, which is the fact that, or the requirement, that the delivered items must have standalone value? So the question is, whether that issue should be considered as well. Should the task force provide additional guidance on standalone value? But at this point, after discussion, the task force has decided that people haven't raised questions about standalone value, and therefore we shouldn't do it. Now, please keep in mind that we're saying thus far people haven't raised questions about standalone value. Once you move the emphasis away by eliminating 9b, it's open to question whether there will be issues about standalone value. The other thing that I think is very important is that what will the consequence for the order of delivery be? Because remember, when you need to have objective and reliable evidence of the fair value of all the undelivered elements, order of delivery is extremely important. So it's likely that that might be affected as well, the order of delivery issue. Okay? Now, another thing I want to point out is if companies are allowed to use an estimated selling price, either with the residual method or companies are allowed to use the estimated selling price using a relative sales price allocation method. In other words, we do away with the residual method. What is the rationale? Why would companies continue to develop VSOE or look for third-party evidence? Because it's always going to be possible to use estimated selling prices. Now, think about that. For example, one of the issues is, of course, for those of you who are from auditing firms, that's something that you're going to have to think about. How are you going to approach companies that tell you, okay, developing VSOE is very, very difficult, it's very costly, we're not going to do it? Is that going to be something that you'll accept? So that's one of the issues that I think people have to keep in mind. Now, some issues with respect to the estimate of the selling price or the estimation of the selling price. By the way, I'm just being slightly facetious only over here. I like this acronym that I have, the ESP. So you get it, extrasensory perception, rather. But we're talking about estimation of the selling price. Now, the question that we discussed last month at our task force meeting, how should we approach this whole issue with respect to the fact that do we allow companies to use estimated selling price when they don't have VSOE, objective reliable evidence of fair value, or third-party evidence? Of course, what that means is that a broader set of data sources will be used by preparers and auditors, and effectively, that's what they'll be doing when they're making and evaluating their best estimates of the sales. So that's been the rationale provided, that we'll get good information. Now, some questions with respect to the selling price that you really ought to think about. What about the reliability of these estimates? Is it always going to be possible to come up with reliable estimates of selling prices? What are you going to do, for example, with products that are new, that you've never sold before? The second question that I think matters over here is what disclosures would help? Now, this is from the user's perspective, right? You're sitting outside the company. The company has prepared a set of financial statements. There's this rather significant change in revenue recognition. So the amount and timing of revenue recognition changes. What kind of information does a user need to ascertain whether this is reliably done? The question also from the perspective of a preparer, management then is going to be that you now have the ability to use estimated selling prices. Given the types of disclosures that you would be willing to make about the estimated selling prices, are you opening yourself up for significantly higher reporting risk? Okay. The couple of other questions. Do we know whether we're always going to be able to come up with the best estimate of selling prices? Now, the task force and the FASB staff response really has been that separation, now that it's going to be easier to do than it was under 0021, will give us a much better economic result than accounting for the bundle as a single unit. Now, please note, as I say on this slide, I believe that this is an assertion. This is a belief. There's no evidence that's been provided for this. Now, in order to accept this, I think you have to make the assumption that what EITF 0021 required before was incorrect. And I think it's worth thinking about whether that's the case. Okay. Now, there are some interesting questions about allocation of revenue. What about the relationship between the residual method and a limit on the amount that can be allocated to a delivered element? Now, of course, since there's a tentative agreement to eliminate the residual method, this question is no longer relevant. So in effect, there probably won't be any limits on how much you can allocate to the delivered element. Another issue is disclosures. What kinds of disclosures are actually going to be useful? So you see, what's happening here is the amount and timing of revenue recognition will change under 081. What kind of information do I need as an analyst, as a user, as someone who's invested in this company? What kind of information do I need? Is that information going to be available? Will companies be willing to provide that information to investors? Or will there be claims of, damage from a competitive perspective? So I think disclosures are a very, very difficult aspect of 0801, and yet they're an absolutely critical element of 081. Now, a working group has been formed, and I'm a member of that working group as well. We're just going to have to wait and see how that proceeds and what we can do in that working group. Okay. Now, transition is going to be a very, very big issue as well. There's very little stomach, I think, for retroactive transition. So chances are it'll have to be prospective adoption. But it's not neither is that very straightforward. There are issues to consider there. And what about transition disclosures? What kind of information are we going to need? So effectively, there's a lot of work to be done. I think that it would make a lot of sense for companies to start working on this. You need to start thinking about what kinds of documentation, what kinds of processes you will require in order to implement EITF 0801. And for that, as I said, I think you really ought to take a look at it. You have to start working on it. And that brings me to my seminar schedule. I would recommend, we've got a couple of seminars coming up in the next one's in Boston on the 1st of May. And we have one on EITF 081 and 089 following on the 18th of May in San Jose. I do recommend that you consider those because we'll be discussing not only in detail what we've talked about today, but I will also talk about implementation issues and how can we get ready for these things. And then I come to the last slide that I have, and here's some more information on some basic revenue recognition courses. For those of you who are just starting out, I invite you to attend one of these. Bob, it's all yours.
Well, you know, Tony, this is a historic event where you have left so much time for questions. So I will remind people, just because some people have asked some questions, and certainly there's plenty of room for more. So the way you do that is to look at your console and ask a question is lower left-hand corner. Click on that, send it, and I will do my best to get as many in as possible. I will also remind people there were some questions. Kind of got a copy of the slides. I covered that up front, and I will cover that again at the end of the webcast in terms of how you get your CPE credits, how you get copies of the slides, and so forth. So we do have lots of questions, Tony. So let's get into them, and people can keep them coming. Tony, lots of questions about again, a lot of these people on this call are software companies. So there certainly are a good deal of questions about the applicability of this to software companies. Is it likely that 0801 will apply to software transactions currently under 97.2? Let me just give them all to you, and then you can kind of consider them at once. And how does 0801 impact multi-element arrangements that include software elements? And things like that. So that's kind of generally the questions relating to software companies.
Okay. Let me begin by saying first that throughout our discussions on 0801, the task force has considered this. We've thought about the applicability to software, and I believe, as I pointed out earlier, in developing and doing the work on 0801, the task force decided that they would not make it applicable or apply it to software transactions. That I just begin. Let me clarify that or explain that a little bit more. So the first thing is that EITF 081 is limited to the transactions that are under the scope of EITF 0021. Of course, that begs a question. What is it about software transactions that are so different that they should not be affected by this issue, by the same accounting? Why shouldn't we apply the same accounting standard? Excuse me. Now, one of the things that we're doing is we're looking at a series of questions with respect to software companies in another EITF issue, EITF 0903. Now, with 0903, we're going to tackle this issue head-on. We're going to take a look at it, think about how it's possible, however, that 0903 may be limited in scope as well. So it may only apply to certain kinds of software transactions. So I think it's very important to keep tabs on 093. Now, I serve on the working group on the EITF 093 as well, and maybe one of the things we'll do as soon as we get a little bit better information on 093 is at least do another one of these webcasts on it. Now, Bob, you had also asked a slightly different, another part of this question, which is what about multiple element arrangements that include software?
Right.
Right. Now, there you have to be very careful. If you're talking about multiple element arrangements that include some software deliverables and other non-software deliverables, then, as you know, today what 21 would require you to do is to separate the software deliverables from the non-software deliverables using EITF 0021's guidelines, which now means you're going to be separating them using EITF 0801 guidelines. But please keep in mind you've got to watch very carefully because it's likely that we're going to change some definitions in EITF 0903. So this is actually a very, very good question, but the answer, a good answer, will only be possible after 0903 is done. So at the moment, what I've said so far applies, of course, but please keep in mind that you have to, for software companies, you must be very, very careful about what's happening in 093. But even more importantly, I urge software companies to carefully review 093, and if there's something you think we're not doing at the EITF, I'd like you to tell us about it. Okay?
Tony, many of our customers are SaaS-based businesses. Could you answer the same question that we asked just a moment ago for software for those people who would consider them a SaaS, software as a service-based business? Or
Right.
Is it the same answer?
Well, in a sense, actually there's a slight difference, so let me elaborate on that. I think it's very important to keep in mind that when you're selling software as a service, you actually you're not subject to 97-2. Now, of course, you start with software as a service and then it develops. It could become other things and so on. But if you stay that way, then you are subject, so long as you're selling software as a service along with other deliverables, right? Then you're going to have to be careful. Are you providing training? Are you providing consulting services? Is there anything else that you're doing? So, you can have in a software as a service environment, you can certainly have multiple deliverables, but then you are going to be subject to EITF 0801 because you're not in software, you're not in 97-2 if you're software as a service. But see, one of the most important things people have to do, and I don't think people do this very well, is you have to think carefully about what your deliverables are. You have to identify those deliverables carefully and then apply it. But if you do find you do everything appropriately and find that you're not in 97-2, then and you have multiple deliverables, then you're going to be in the EITF 0801.
When you talked about standalone value, and you said there hasn't been a whole lot of comments on that, and that triggered a lot of questions about. You seemed like you were surprised that there weren't a lot of comments on that, and is the standalone value. So if you can elaborate on that, how you see that playing out, and as a follow-up to that on standalone value, is that from the customer's perspectives or a vendor's perspective, the standalone value?
Okay. What I meant when I said that there weren't a lot of questions is what I was saying is that at the task force discussions, we decided not to provide additional guidance on standalone value. And the reason we did that is because we haven't been inundated with those questions. People haven't been asking us, give us more guidance on standalone value. Now, having said that, it doesn't mean that it's always that straightforward. Now, if you think back to 0021, paragraph 9A, as I said, talks about standalone value. What's the meaning of that? Probably the best way to think about standalone value is when that particular item is sold separately. In other words, the vendor sells the delivered item all on its own outside of the bundled arrangements, which therefore, the fact that the vendor sells it separately implies that the customer derives a value from it, which is why they're willing to sell it, which is why they're willing to buy it, rather. Now, please keep in mind one other issue that's very, very important, and that is when we're talking about standalone value, what if the vendor does not sell the item all by itself? Then the question is, does the customer have a right to sell that particular item on? Forward, that is. Now, if the customer is not prohibited from selling it, then there is standalone value. Of course, the customer should be able to sell that item for and get value for it. If they can only sell it for scrap, then that doesn't count. So in that sense, we look at standalone value in terms of whether that product is being sold separately all by itself. So those are some of the issues to consider.
So to be clear on that, because we have a follow-up question to that, Tony, so if a vendor never sells an element separately, they never do that, would the model allow for the use of an estimated selling price, ESP as you call it, or would this point to a single element arrangement?
Yeah, if the item is not sold separately at all and the customer can't say prohibited from selling it, right, then you haven't met the first criterion and then you will be in.
Okay.
Right? Yeah.
You have to cross that hurdle for first. Okay. On ESP, estimated selling price, you comment on a broader set of data sources. Now, when people deal with VSOE, the question of how broad a set of data sources are needed for that. So there were some questions about, by broader set, what do you mean? Broader than what? And, of course, it gets back to how many.
Okay. Well, the way I look at it, VSOE, or objective and reliable evidence of fair value, if we think back to 97-2, which has the definition, which basically says the price at which an item is normally sold separately, right? So which means what you're doing is looking at actual selling prices when that particular item is sold all by itself. So when you think about that, what I'm saying is that, and what you find, what you will be doing is you develop VSOE using a single piece of data, which is the selling price, the actual realized selling price. That's one thing. Now let's think about where are we going to get estimated selling prices from. There's going to be a lot of internal information that's generated because you're going to have to think about the costs. You're going to have to think about the margins. And by the way, you ought to take a look at, there are several examples that are attached to the draft abstract of EITF 0801. One of those examples actually shows you a fairly simplified, stylized example on how to come up with an estimated selling price. So in one sense, it's broader simply because you're looking at costs, you're looking at margins, and so on. Whereas the VSOE was based on a single realized sales price.
Tony, lots of questions about when this will be effective, if and when, and the transition and things like that. So when will it, do you think it might be effective? What transition period do you think there might be? You mentioned transition a little bit in your presentation. And will its use be prospective or include retroactive application?
Okay.
We cram lots of questions into one question. So
yeah,
in the interest of time.
Say, it's the day for multiple element questions.
Multi-element questions.
Yeah.
If anyone should be able to deal with them, it would be you.
Yeah, and well, each of them probably has standalone value, so we'll see what we can come up with.
There we go.
Okay, so
the county humor.
Well, we got to do something about it. So, transition and when. So the first question is, when is this likely going to happen? Now, I would say, we'll have a meeting in June, and the June meeting should, of course, help see that. At the moment, the plan is that it would be effective for periods beginning after December 15th of this year, which is a fairly short period of time to get ready for it. Although I must say that many of my clients who I talk to about this and other people that I've had occasion to discuss it with certainly seem to think that everybody wants this, and therefore I've learned one thing over the last several years that I've been in this part of standard setting. If they don't want an accounting standard, then you'll never be able to give them enough time. But if they want an accounting standard, then it never is a problem. So in that sense, who knows? It's not going to be that big an issue. On the other hand, I think it's a lot of work, and so you have to keep that in mind. So it's likely that it will be this year. The actual transition method, I think, and again, please keep in mind this is my opinion. I'm just, thinking about what other people were saying. We haven't really had a vote on this in a sense. But I think that the sentiment is very much in favor of a prospective application. And sometimes when I think about it from an analyst perspective, I think that might be a good answer too. But at the same time, I really would not want to completely lose comparability. So from that perspective, it's a very difficult question. But if I had to come up with, an answer at the moment, I would say chances are it's going to be prospective, with some, hopefully, good disclosure requirements. Although that, I think, is going to be an uphill fight. Okay?
Sure. This has triggered a lot of questions on 0903. as you'd expect. So the same questions that I asked just now about 0801, about timing, and but more so because 0903 is earlier in the process in terms of when we might have more data on that, and any insight you can do on that, give us on that would be helpful with regard to its timing.
Okay. Well, I mean, you've got it. You know, the questions have certainly, and the people asking them have certainly recognized the issue. But here's the thing. What's very interesting is when we first started working on it, the task force and the FASB staff have always been cognizant, very cognizant of the fact that it really would make a lot of sense to have both of these effective at the same time. So it really is very difficult to see, you know, how you could actually have a staggered effective date. But on the other hand, as you just pointed out, 0903 is very much in its early stages. We've had one working group meeting so far. I don't know that there's another one planned. We might have one. But at the same time, the issues are, again, every bit as complex as they were with 0801. And I think a couple of transactions that I've seen, acquisitions in the last few weeks, are going to make it even more interesting to see what happens with 0903. So in that sense, I think you know, we're going to have our work cut out for us in June. I'm sure the FASB staff is working very hard on 093 as well. And I'm sure that the international, you know, people who use IFRS, the foreign companies are probably also looking at this with some trepidation because there aren't equivalent standards in the IFRS. And so these changes are going to bring about a lot of thinking on the part of the companies that use IFRS, which, as I've said before, many of them end up using 97-2 for software since there isn't an equivalent. The material and the guidance, I should say, in IFRS for 0021 is really not really substantive. I know I have a different opinion on that from others, but I've never thought that mentioning something in one sentence in a standard really qualifies as guidance, and that's how I think they talk about 0021. So I think 081 is going to be a rather interesting effect as well. But to go back to the basic question, 0903, it would be good if it were done and became effective at the same time. Right now it seems like that might be a tall order, but we'll have to see what happens in June.
Any guidance, Tony, on how people should be thinking about transitioning or documenting their transition in terms of the use and applicability of 0801?
I think the fundamental issue that you have to come up with is what do you need to develop the selling price, estimate of the selling price? That question and how you answer that will give you the information you need to start thinking about documentation and so on. But you have to start thinking, you have to start preparing for it. It is going to take a fair amount of work. And, of course, you can always come to the seminars.
There you go. All right, we're up against the clock. Let me just give you some more instructions here. First, thank you very much, Tony, for taking time out from your busy schedule and joining us from across the pond. Thank you for all your questions. We got hundreds of questions, so if we didn't get to your question, we will address them one-on-one. And sorry we didn't get to all of those as well. RevenueRecognition.com has a forum for people to share their ideas and thoughts. You can see that on your screen now. For those of you who'd like to correspond and get some feedback from your colleagues in the industry who are working through the same issues, visit RevenueRecognition.com/forum. And please stay tuned to RevenueRecognition.com, your emails, and SOFTRAX.com for other webcasts such as this. I'm sure there'll be follow-up webcasts on this from Tony. And thank you very much, Tony, for everything. And thank you to the audience. Bye-bye.